Global equity markets continued to move higher in the third quarter, with the MSCI World Index gaining about 6.4% in dollar terms. However, in contrast to the very narrow US tech-driven rally of the previous quarters, there was a noticeable rotation into more interest rate sensitive sectors such as consumer staples, utilities, and listed property over the third quarter. This came as economic data provided enough comfort for the US Federal Reserve to finally commence with its interest rate cutting cycle. Globally, the balance of inflation versus growth risk has shifted. We're now in a synchronized rate cutting cycle across most of the world, excluding Japan. Historically, market performance over these kind of easing cycles really depended on whether economies avoided recessions or not, and recessions occurred around 2/3 of the time. So while we see the US labor market cooling, the US general economic activity remains quite healthy. Inventory and credit cycles, those are bottoming, and they can probably support the next leg of growth. Private sector balance sheets are also in generally quite good shape, which does increase the probability of a soft landing in our view. The stars really seem to have aligned for South African assets over the last couple of quarters. Firstly, the positive election outcome supported local sentiment. Secondly, the prospect of that US soft landing I spoke about and of lower interest rates combined that beneficial for emerging markets as a whole. Finally, the stimulus measures that were announced in late September by Chinese policymakers certainly had a positive impact on many large cap JSE listed shares such as the Miners, Naspers, Richemont. In our view, the next leg for South African assets to outperform their global peers on a relative basis will likely require the positive post-election sentiment to convert into actual reforms and real growth. In the meantime, I'm just happy that the power has stayed on uninterrupted for 6 months. Moving to asset class performance, US equities dominated the quarter. The MSCI World and S&P 500 indices were up around about 6% over the third quarter. European stocks rose about 7% in dollar terms, while MSCI emerging markets did quite well. That was up about 9% in dollars, certainly driven by the 24% return we saw from China. From a style perspective, the value factor performed best, rising nearly 10% over the quarter. By contrast, quality, growth, and momentum factors all lagged. They delivered about 3 to 4% as markets broadened. When we look at sectors individually, utilities led the charge. They were up 18% in the quarter, while financials gained 11% and tech was only up 2%. Energy stocks fell about 2% in the quarter. Global bonds saw improved performance. They were up about 7% of the quarter to be 12% up for the 12 months. With markets pricing in a number of interest rates cuts, we now see the risk tilted slightly to the downside for bonds in the fourth quarter. In the commodity space, oil fell a substantial 17%, while gold continued its run, up more than 13% over the quarter, helped by a weaker dollar and the beginning of the rate cutting cycle that I touched on earlier. Our conundrum on gold remains whether further expected rate cuts can push gold prices up from an already high base, given that the US economy appears poised to achieve its soft landing. When looking at South Africa, the rand strengthened in the months after the election, ranging between 18.60 and 17.20 against the dollar. It ended the quarter about 5% stronger at 17.27. Our base case remains for the rand to continue to appreciate over the coming months. Our local equity market in SA had an excellent quarter, rising 16% in dollar terms and 10% in rands. That's comfortably ahead of both emerging market and developed market peers apart from China. Within our market, financials extended their good performance to rise almost 14%, while industrials added 11% over the quarter and resources fell by 1%. Our local bond market delivered nearly 11% over the quarter, while cash delivered 2%. The house view equity model's performance over the third quarter was encouraging in absolute terms, rising 8% for the quarter to be up 14% so far this year. Over the past 5 years, this portfolio returned north of 13% per annum after fees, which is nearly 9% per year ahead of inflation and more than 2% per year ahead of its average peer. So far in 2024, our exposure to Prosus and Pepkor has helped relative performance, while holding Sasol acted as a drag, as did not owning Capitec. The Sanlam Private Wealth Equity Fund remains in the top quartile of its peer group over 3, 5, and 10 years. Our worldwide equity portfolio lagged its benchmark marginally in Q3. While this portfolio has good exposure to growth via businesses like Google, Microsoft, SAP, and others, in general, its positioning was tilted a bit more towards defensive names. We're certainly encouraged by the improved performance over the quarter of the largest offshore building block, that being the Sanlam Global High Quality Fund. If we then move across to our Regulation 28 multi-asset portfolios, the short-term performance was a little bit disappointing. The balanced and moderate balanced portfolios were marginally behind their benchmarks for the quarter after fees, although the conservative balanced portfolio was ahead. Far more importantly, though, these portfolios remain ahead of benchmark over 3 years, where they've delivered around about 5% above inflation. In terms of activity within the portfolios, we added further South Africa Inc. exposure by buying Remgro in July. We also switched some of our Anglo Gold exposure into Goldfields to diversify some of that single gold miner risk. And then in September, we took advantage of global markets' temporary enthusiasm for defensive stocks to trim our holding in British American Tobacco. That's after that share had re-rated quite substantially. We then recycled the cash into Bidcorp, which we believe has among the best long-term secular growth stories on the JSE. In the balanced mandates, we also extended the duration of our SA government bond holdings. Overall, our positioning across our portfolios is less defensive than it was 3 months ago, but it's still slightly conservative given our concerns around valuation for global equities. When we look at global stocks, prices are still well above average on a forward-looking price-to-earnings multiple basis, while only the US economy really is doing well. The market is pricing in quite healthy profit growth in 2025, but as the early August wobble in Japan showed, sentiment can really change quite rapidly. In South Africa, despite the rally since the GNU was announced, our market is still attractively priced relative to global peers. And given the encouraging outlook, our SA equity holdings are now more balanced between South Africa Inc. exposures and Rand hedge exposures. Global equities still appear a bit expensive relative to bonds. What you see is the premium that investors are being paid to take the extra risk associated with holding stocks versus bonds. That's improved slightly, but it still remains low relative to the last couple of decades. In conclusion, the odds of a US soft landing have increased, but we're not yet out of the woods. It's important not to become complacent about inflation and growth risks given where assets are priced. This, coupled with slightly elevated geopolitical tensions, does call for a diversified approach to portfolio construction. More stimulus from China would clearly be positive for South African assets. In the longer term, we do see material risk around the sustainability of government finances, given elevated debt levels and higher debt servicing costs. This likely points to rising inflation risk, and portfolios should focus on assets like stocks and other real assets to hedge against the devaluation of fiat currencies over the long term.